This is becoming a pattern. One of the richest men in the world lost 2/3 of his wealth in a matter of days after a small research organization accused him of running a Ponzi-like scheme. The man is Carl Icahn, a Wall Street legend who made a name for himself as a corporate raider. Now it looks like the raider is getting raided. A month ago, Carl Icahn was worth $25 billion, making him the 58th richest person on Earth. Today, his net worth is $8 billion and falling. And it's all because Hindenburg Research, a tiny 10-person research organization headed by Nate Anderson, released a scathing report against Icahn. Here's what's going on. So Carl Icahn runs a company called Icahn Enterprises. And it's essentially a holding company that owns a mix of assets, things like real estate, private businesses, and publicly traded stocks. But the biggest holding of Icahn Enterprises is a stake in Carl Icahn's private investment fund. This fund only has 3 direct investors, Carl Icahn himself, his son Brett, and the company Icahn Enterprises. The fund's goal is to make money through activist investing, which is a nicer sounding term for what used to be called corporate raiding. This is when an investor takes a big stake in a company and then actively pushes for changes in things like its management or operations in order to unlock value and generate higher returns for shareholders. Now, Carl Icahn has a reputation of being a fierce activist investor who corporate executives fear. When he buys into a company, he often pushes for aggressive changes that sometimes include the firing of CEOs or other executives. Over the years, he's tussled with companies including McDonald's, Texaco, and eBay, and he's made a lot of money doing it. There's even been movies made about Carl Icahn's exploits. So that's a big part of why people invested in Icahn Enterprises stock. By investing in the stock, you get exposure to this activist fund that's run by Carl, and you get exposure to the other assets that he invests in, like I said, real estate and various public and private businesses. It's essentially a way to invest alongside Carl Icahn, who has this iconic reputation on Wall Street. But you see, Carl Icahn isn't the only reason that people invested in Icahn Enterprises stock. It also offered a massive dividend to investors. The dividend is $2 per quarter, which if you use the price that Icahn Enterprises stock traded out before the Hindenburg report came out, equals a 15% annualized yield. At today's lower stock price, the yield is 35%. Obviously, that's a very attractive dividend yield, and you can see why so many people would be interested in investing in something that pays 15% or more per year. But what Hindenburg discovered is that the yield on Icahn Enterprises stock wasn't funded by profits, as dividend yields usually are, but by stock sales. Since 2014, Icahn Enterprises has had negative free cash flow of $4.9 billion. Yet it's paid out $1.5 billion of cash dividends. How did it do it? By selling stock. This is what Hindenburg referred to as a Ponzi-like structure. Icahn Enterprises sold stock to new investors in return for cash, and then it turned around and used that cash to pay dividends to existing investors. No value was created. It was just cash going from one set of investors to another set of investors. Now, this worked for a couple of reasons. One is that Carl Icahn owns 85% of Icahn Enterprises stock, and he's agreed to take his dividends not in cash, but in additional stock. That meant that the company only had to raise enough money through stock sales to pay cash dividends to the other 15% of shareholders, which is a much smaller amount of money than if it had to pay cash dividends to 100% of shareholders. But Icahn wasn't foregoing cash dividends out of the kindness of his heart. He was getting additional stock to make up for the cash that he was foregoing, and because Icahn Enterprises was paying such a high dividend yield, it attracted a lot of investors who bid the stock up to exorbitant levels. Before the Hindenburg report came out, Icahn Enterprises stock was trading at more than 3 times the value of its underlying assets, which was perfect for the company because it could easily sell stock and keep this scheme going. But that raises the question, why was it doing this? Why bother selling stock to raise cash only to send that cash right back into the hands of shareholders? Well, Hindenburg argues that Carl Icahn wanted an inflated stock price so he could use it as collateral to borrow money. The higher the stock price, the more money that lenders like Morgan Stanley would let Carl Icahn borrow. Now, it may seem odd that a billionaire would need to borrow money, but there's a couple of reasons why he might want to or need to do that. First, most of his net worth, 85% of it, is tied up in Icahn Enterprises stock, but he can't easily sell the stock because it would be very difficult to do so without negatively impacting the price, and he wants to keep the stock price high. Borrowing money using the stock as collateral enables him to raise cash without selling stock. And that's exactly what he's done. Carl Icahn has borrowed billions of dollars over the past several years, and guess what he's done with it? He's put it into his activist fund. You see, despite Carl Icahn's reputation as a brilliant investor, his activist fund has performed horribly over the past decade, largely because of bearish bets against the market. Carl Icahn expected the market to go down, but it's gone up, and his bad bets have resulted in a 53% loss for the fund since 2014. So by borrowing money, Carl Icahn was able to replenish the investment fund's coffers, giving it more firepower to launch its activist campaigns. Because after all, no company is going to take an activist investor seriously unless that investor has enough money to buy up a lot of stock and throw their weight around. So this scheme that Carl Icahn was orchestrating, selling stock and then turning around and paying out cash in dividends, was a way for him to keep Icahn Enterprises stock high so he could use the stock as collateral to borrow money, which he could then put into his activist fund to make up for bad investments that the fund had made. It was a pretty convoluted process, but it was working for years until Hindenburg uncovered it and released their report. Now the scheme is at risk of falling apart because it depends on Icahn Enterprises stock staying high. If the stock drops, well, Carl Icahn could have some big problems. And unfortunately for him, that's exactly what's been happening. Since the Hindenburg report came out, Icahn Enterprises stock has fallen by more than 50%. But even after its decline, the stock is trading at a premium of more than 40% compared to the value of its assets, suggesting that there could be more downside to come. Making matters worse, if Icahn Enterprises stock falls enough, it could trigger margin calls for Carl Icahn. Remember how I said that Carl Icahn has borrowed money using his shares of Icahn Enterprises as collateral? That's known as a margin loan. The way margin loans work is the borrower needs to keep the value of the collateral above a certain threshold. If they don't, they could get a margin call. So as the price of Icahn Enterprises stock has fallen, Carl Icahn's collateral has decreased in value, and he's had to post more and more of his shares as collateral for his loans. A couple of weeks ago, the company came out and said that Carl Icahn had posted 65% of his shares as collateral for loans. The concern is if the stock keeps dropping in value, at some point Carl Icahn's lenders might force him to sell his stock to repay his loans. That could lead to an even sharper drop in the stock, leading to more forced selling in a vicious cycle. So this could be really bad for Carl Icahn, but it's not his only problem. A day after the Hindenburg report came out, federal prosecutors opened an investigation into Icahn Enterprises. As of today, they haven't charged the company with any wrongdoing, but prosecutors may be looking into certain allegations made in the Hindenburg report that I haven't talked about yet. The report points to several suspicious instances when Icahn Enterprises marks the value of its assets at prices well above what they should have reasonably been valued at. In one example, Hindenburg said that Icahn Enterprises kept the value of its real estate portfolio essentially unchanged over the past several years, even though one of its biggest properties, the Trump Plaza Hotel and Casino in Atlantic City, was demolished in 2021. In another example, Icahn Enterprises marked the value of its stake in a publicly traded meat packing company at a $243 million valuation, even though it was worth only $89 million based on where the stock was trading in the public stock market, which everyone could see. So these are all concerning things, and when you combine them with that whole margin loan scheme I talked about earlier, it's not surprising that shares of Icahn Enterprises have been plunging ever since the Hindenburg report came out. For his part, Carl Icahn has come out and blasted Hindenburg. He and his company have come out and said that the research organization is, quote, wantonly destroying property and harming innocent civilians, which sounds a little bit hyperbolic if you ask me. Of course, we've heard things like these before. In January, after Hindenburg released a report accusing India's richest man, Gautam Adani, of fraud, he and his company fired back, accusing Hindenburg of being the Madoffs of Manhattan and of attacking India itself. As of today, Adani's net worth is still down $60 billion or 50% from where it was before the Hindenburg report came out. So Hindenburg is used to taking this kind of heat from some of the richest people in the world. This time around, it just so happens to be Carl Icahn, a man who made his name and fortune holding corporate insiders accountable for mismanagement and questionable behavior. Now the tables have turned and he's the one being held accountable for questionable behavior, which is kind of ironic. So we'll see what happens. Is Icahn gonna go broke? Probably not. In the worst case, he'll be forced to sell his stock, maybe at very depressed prices. But unless there's some hidden landmines we don't know about, he'll still probably come out of this a billionaire. He just won't be nearly as wealthy as he once was, and he'll probably be embarrassed that his reputation as a brilliant investor took a hit because of Hindenburg's findings. That's it for now. Follow for more investing insights.